The U.S.-Iran war will make some investors rich, not all investors, some, and the difference between those two groups will not be intelligence, connections, or access to secret information. It will come down to one thing: whether they understand what happens next before everyone else does. Because right now, while most people are watching oil prices, headlines, and fear spreading across markets, the smartest money in the world is quietly preparing for something very specific, something Bank of America just warned its wealthiest clients about in a private note that never reaches retail investors. Not you, not me, but hedge funds and institutional players who pay tens of thousands every year for access. And what that note says is simple but powerful: a policy panic is coming. And when it arrives, the investors who are positioned correctly before it happens will make the kind of returns that normally take a decade in just a few months. And that is why this moment right now is one of the most important financial windows you will see in years. Because this is not just another market dip or another geopolitical headline. This is a full-scale macro shift playing out in real time 5 weeks into a conflict that has already started reshaping global markets. The S&P 500 has dropped significantly from its highs. The Nasdaq is falling even faster. Oil has surged past critical levels. Consumer confidence is collapsing. And yet something very unusual is happening beneath the surface. Something that most people are completely missing, because while fear is rising and markets are falling, bond yields are not behaving the way they normally would in an inflation shock. They are falling, and that single signal changes everything, because it tells you that the market is no longer primarily afraid of inflation. It is starting to fear recession more. And that shift from inflation fear to recession fear is the exact trigger that has historically led to some of the biggest investment opportunities in modern history. But to understand why, you need to understand the mechanism that turns a war into wealth. Because wars themselves do not create opportunities directly. They create distortions. They break normal pricing. They force investors to react emotionally, and in doing so they create a gap between what assets are worth and what they are being sold for in panic, and that gap is where money is made, not by predicting the war, not by reacting to headlines, but by understanding what happens after the initial shock, and right now we are deep inside that initial shock phase, where everything feels uncertain, where safe havens are not acting like safe havens, where even assets like gold are under pressure, where investors are either panicking and selling or freezing and doing nothing. And both of those reactions will likely look like mistakes in hindsight, because what comes next is not more chaos in the same form. It is a shift in policy, a response from central banks and governments that is designed to stabilize the system. And that response is what creates the opportunity. Because when policy changes suddenly, markets do not adjust slowly. They reprice violently. And that is exactly what Bank of America is preparing its top clients for, not the war itself, but the reaction to it, the moment when fear reaches its peak and policy steps in. And that moment is closer than most people think, because the conditions are already forming. Oil prices are high enough to damage economic growth. Consumer sentiment is already collapsing. Markets are already pricing in significant risk. And when oil reaches levels that start to choke the economy, something counterintuitive happens. Inflation risk actually begins to decline relative to recession risk, because high energy costs slow everything down. They reduce demand. They weaken consumption. And eventually they force central banks to shift their focus from fighting inflation to supporting growth. And when that shift happens, when the Federal Reserve moves from thinking about rate hikes to considering rate cuts or liquidity support, the entire market narrative changes. The assets that were being sold aggressively suddenly become the biggest winners. And this is the part most investors miss. They focus on what is going up during the crisis instead of what will go up after the response. They chase energy stocks after they have already surged. They chase defense stocks after the move is already crowded. And in doing so, they arrive late. And arriving late is how losses happen, not gains, because the real money is not made in what has already moved. It is made in what is about to move when the environment shifts. And that shift is what the policy panic represents. It is not panic in the traditional sense. It is a sudden change in expectations, a moment when markets realize that central banks and governments are stepping in more aggressively than expected. And when that realization hits, money moves fast, very fast, into the assets that were previously beaten down the most. And this is why timing matters so much right now, because we are in that narrow window before the shift, before the confirmation, before the headlines change. And historically, this is where the biggest opportunities exist. Not when everything is clear, but when everything feels uncertain, because by the time certainty arrives, the move has already happened. The prices have already adjusted. And the easy gains are gone. And this is why most investors miss these moments, not because they lack information, but because they wait for confirmation. They wait to feel safe. They wait for headlines to turn positive. And by the time that happens, the market has already moved without them. And right now we are seeing all the classic signals that precede that kind of move: oversold conditions, extreme pessimism, collapsing sentiment, rising volatility, and most importantly, that shift in bond yields that signals a change in what the market fears most. And when you combine all of these factors together, you get a setup that historically leads to powerful recoveries, not gradual ones, but sharp, aggressive moves that reward those who acted early. And that is the key idea you need to understand. This is not about predicting the exact bottom. It is about positioning before the policy response changes the game. Because when that happens, the speed of the move will not give you time to think. It will not give you time to analyze. It will reward those who were already prepared. And that is exactly what the smartest money is doing right now, not reacting to the war, but preparing for what comes next, because they understand something that most people do not. The biggest opportunities in crisis are not found in the chaos itself. They are found in the response to it. And that response is coming. Now let's move into the part that matters most, where exactly the money flows when that policy panic arrives, because understanding the mechanism is only half the equation. The other half is positioning correctly before the shift happens. And this is where most investors get it wrong. They either stay frozen in fear or they chase what has already moved, instead of focusing on what is about to reprice the fastest when conditions change, and according to the same institutional framework being shared with top-tier clients. There are very specific sectors and asset classes that stand to benefit the most from this transition from fear to policy response. And the first one is not what most people expect. It is not oil producers, not the companies already making headlines, because those have already experienced their surge. The real opportunity sits one layer deeper in energy infrastructure, the pipelines, storage systems, and LNG facilities that act as the backbone of global energy movement, because these businesses do not depend on guessing oil prices correctly. They collect consistent revenue based on volume and usage. And in a world where supply chains are being disrupted and rerouted due to geopolitical tension, their importance increases significantly. Governments and corporations invest more into alternative routes, redundancy systems, and long-term infrastructure, and that creates a sustained tailwind that extends far beyond the immediate crisis, making them one of the most overlooked but structurally strong plays in this environment. The second sector is defense and aerospace, and this one is more straightforward but still widely misunderstood because most people treat defense stocks as short-term trades tied to active conflict, when in reality they represent long-term government spending cycles that continue for years after the headlines fade, military budgets expand, contracts increase. Technological development accelerates, and these trends do not reverse quickly. They become embedded into national policy, meaning that this is not just a reaction to the current situation, but a structural shift in spending priorities that can drive consistent growth over multiple years. And the key here is not chasing individual names after spikes, but gaining broad exposure to the sector's long-term trajectory. The third sector is where things become counterintuitive and where the biggest asymmetry often exists. Consumer discretionary, the very companies that look the weakest right now, the ones being sold aggressively as confidence drops, as spending fears rise, as recession headlines dominate. But this is exactly why they become attractive, because markets tend to overcorrect during periods of fear, pushing valuations far below their long-term fundamentals. And historically, when these conditions reach extremes, the recovery in these sectors is not just strong, it is often among the strongest, because as soon as policy support enters the system and sentiment stabilizes even slightly, these beaten down names experience rapid revaluation. And this is not speculation. It is a pattern that has repeated across multiple cycles, where the assets that were punished the most during uncertainty become the biggest winners during recovery. And closely connected to this is the opportunity in software and technology infrastructure, particularly those tied to long-term capital expenditure cycles like artificial intelligence. Because while the market is currently treating these companies as if their growth story has been interrupted or canceled, the reality is very different. The massive investment commitments from major corporations into AI infrastructure, data centers, and digital ecosystems are not dependent on short-term oil price fluctuations. They are part of multi-year strategic plans that continue regardless of temporary macro disruptions. And what we are seeing right now is a broad liquidation event where assets are being sold indiscriminately, not based on their individual fundamentals, but based on overall risk reduction. And that creates mispricing, because businesses that are not directly impacted by the current shock are being discounted as if they are. And when the environment stabilizes, these are the exact names that tend to recover sharply. And then there is the financial sector, particularly consumer finance, which stands to benefit from the eventual shift in interest rate expectations, because as the bond market begins to price in rate cuts, lending conditions improve, borrowing costs decline, and financial activity gradually picks up, creating a supportive environment for these businesses. But all of these opportunities depend on one critical distinction. that separates successful investors from the rest, the ability to differentiate between assets that are structurally damaged by the current environment and those that are simply temporarily mispriced due to sentiment. Because not everything that is falling is a good opportunity. Some businesses are genuinely facing long-term challenges due to rising costs, disrupted supply chains, or reduced demand, and these are the ones that may continue to struggle even after policy support arrives, while others are being dragged down purely by fear and liquidity pressures. And these are the ones that tend to rebound the strongest, and making that distinction requires stepping back from the noise and focusing on underlying fundamentals, asking simple but powerful questions. Is this business directly harmed by high oil prices? Does it depend heavily on cheap capital? Is its demand likely to disappear or just temporarily weaken? And by answering these questions, you begin to see the market more clearly, separating signal from noise. And once you have that clarity, the strategy becomes much more straightforward, but still requires discipline, because the biggest mistake at this stage is using leverage or overexposing yourself too early. Because even though the setup is strong, volatility is not over yet. Markets can still move lower in the short term. Headlines can still create sharp swings. And if you are forced to exit positions due to leverage or emotional reactions, you lose the ability to benefit from the eventual recovery, which is why one of the most important rules in crisis investing is ensuring that you can hold your positions through uncertainty, because the investors who succeed are not the ones who time every move perfectly. They are the ones who stay in the game long enough for the probabilities to work in their favor. And this brings us to the broader historical context, because what we are seeing right now is not unique. It is part of a pattern that is repeated across decades. Every major crisis, whether driven by war, financial collapse, or economic shocks, has followed a similar structure: an initial phase of panic and uncertainty, followed by a policy response, followed by a recovery that often exceeds expectations. And the common thread across all of these events is that the majority of investors react too late. They sell during the panic, they wait during the uncertainty, and they buy during the recovery, effectively doing the opposite of what generates returns. While the minority who understand the cycle position themselves during the uncertainty and benefit from the recovery. And this is exactly where we are right now, in that uncomfortable middle phase where fear is high, visibility is low, and decisions feel difficult. But this is also where the opportunity exists, because the future path is not as uncertain as it feels. The war will eventually de-escalate. Oil prices will eventually stabilize. Central banks will eventually respond. And markets will eventually recover. The only unknown is timing. And timing is not something you need to predict perfectly to benefit from the trend. What matters is being positioned before the shift becomes obvious, because when it does, the move will already be underway. And this is why watching key signals becomes so important. Bond yields, currency strength, policy announcements, any indication of de-escalation. These are the indicators that provide clues about when the transition is happening. And by monitoring them while gradually positioning into high quality, beaten down assets, you align yourself with the direction of the next major move rather than reacting to the last one. And that is ultimately the difference between investors who build wealth during crisis and those who do not. It is not about predicting headlines. It is about understanding patterns. It is not about avoiding fear. It is about acting despite it with a clear framework. And right now, that framework is pointing toward one conclusion, that the current environment, while uncomfortable, is setting the stage for a significant reallocation of capital, a shift that will reward those who are prepared and penalize those who wait for certainty, because certainty always comes after the opportunity has passed. And as this situation continues to unfold, remember this simple idea: the war itself is not the opportunity. The response to it is, and that response is getting closer.